All right, it says recording, so I hope it is. That was weird because I think we did before. All right, so guys, really excited tonight. We have an awesome deal review of 144 unit, and we have a lot of people showing up tonight. We have over 100 people, and I know there's a lot of new names. I'm looking at them. So in saying that, with the new names, these calls can get very high level. And what we do at Sharpline, we're going to try and not get really high level. We want people to understand, because if you understand, you get excited about the best space multifamily, which is a great asset class. Stocks or paper, multifamily is brick and wood. I like to buy brick and wood instead of fake paper. So I do own a few stocks. I own a lot of crypto though, not a lot of stocks, but mostly I'm 95%, 90% multifamily. So we're going to keep it kind of light and easy to understand. And like I said, you write down questions. Ramo, can you put my website, marcobarbo.com, and my cell phone number in the chat? If
Yep.
you haven't met me and you want to talk to me and ask questions, send me a text tonight, just your name, and say, hey, I'd like to talk with you real quick. I have over 5,000 contacts on this phone, and I network and I talk to a lot of people. So definitely reach out to me. So before we start the call, two real quick wins tonight. We're going to keep this tight and fast. One quick win. The first one is we just closed. We're closing. Actually, didn't just close. We're closing a 40 unit Sharpline deal. Just the company. Just it's a small deal. Just us. It's a $1.5 million down. Great deal, and we're really looking forward to it. Josh, we have to thank Josh Stahl for bringing it to us. He's part of the team. Josh is going to be talking tonight. He's a huge addition to the team. We're building a very, very strong self-management team. So Josh is going to introduce himself later. Grateful for that because deals are not easy to find in this environment. And my second win is a dad win. So I have my daughter Viviana on this call tonight. 2 wins. She just finished a show. She's 19. She's in college. She's going for business. She's going for marketing, and she also does property management classes and stuff like that. All that stuff. She just finished a show in theater, a professional theater in Orlando. All shook up, and the lead was from Broadway. Now Viviana, say hello.
Hi everyone.
See, she just got a call back for Pippin, which is really cool. But the big win is she invested in a 40 unit with me at 19. She actually saved $5,000, sent me the money, and I added 20,000. She put 25,000 in the deal in a 40 unit. Now she's going to be investing in this deal. She actually has 2 jobs, goes to college. She saved $12,000. She's going to send me 12 grand. I'm going to add 13,000. She's going to put 25,000 in this deal. My plan for her is multifamily is a get rich quick slow, not a get rich quick scheme like a crypto and other stuff. Is hopefully 1 deal a year. I want her to work and send me some money, and dad's always going to add a little bit to it. And I want her to have 10 deals by 29 years old. And little by little, the 40 unit's going to refi. She's going to get a nice check because she says, but dad, I don't know if I could save that much. I'm teaching her the law of compounding. So she's learning in college how to get a piece of paper, and dad's going to teach her real education. So that's what we teach. So that's the dad win right now. In saying that, I can hand it over to Nick or Chris. Those are 2 quick wins, and we can get started.
Let it up, Nick.
Did everyone see that?
I got it. All right, let me put my light up a little more here. Get some lighting. There we go. That's a little better. Too bright. I have a black screen that's making it weird. There we go. All right, guys, this is thanks for joining us tonight. We haven't done a Zoom in probably now 3 months, 2 months, about 5 months. We'll go over some of we did close 2 deals last year. We'll go over them. But yeah, we're excited to do this. This is a great deal. The deals are starting to come. There is some level of distress out there, which we were all hoping for last year, but we didn't really see a lot of distress last year. And now it's starting to show up. Distress doesn't also have to mean that the property's messed up. It can be quite a few different scenarios. The loans are coming due. Some sellers are getting ahead of that. They see that there's not as many buyers in the marketplace. It's not as easy to get the right kind of debt. Luckily, Sharpline has great relationships with all different types of lenders, so we know the type of debt to put on the deal to make it the best return, risk mitigated for our investors. Go ahead, Nick. So, Marco was talking about the year of operations last year, and we were kind of joking around about this earlier today, that it feels like it's going to be a few years of operation, because you got to be able to operate your buildings. About 3 years ago, we got tired of using third-party management. You just didn't have the control, the flexibility, the ability to pivot if something was not working right in the market or the team on the ground. So we dove right into creating our self-management company, Sharpline Communities. We started small, got better and better, and now almost the full portfolio of 1,200 units is self-managed, and we've seen a difference. We've been able to cure issues faster. Like we said, be flexible if the market needs to sometimes do specials. You can get occupancy faster. Just allows us to pivot. You'll hear a term, for some people that may have not heard it before. When you self-manage and it's part of the same companies of like Sharpline, it's called vertically integrated, if you've heard that before. And that is an advantage when done right. These are the wonderful people at Sharpline Communities. I don't want to belabor too much, but I love our team. I saw Isaac, and I'm going to embarrass him on 116 people and make him say hello. Isaac, he rose up through Sharpline Communities, is now a district manager of a large amount of units in Kansas City, and he deserves it. Say hi, Isaac. Where is he?
What's happening, everybody?
There he is. He's awesome. Isaac is a key member of the team. He really has risen up. He's dove into it, masters all the little details, and has learned fast. He is a leader in Sharpline, and we are grateful to have him. Just a super stud. All right, Nick, go ahead. All right, these are the recent closings that we've had. The 40 unit A class was in December. So that meant that Zoom was probably sometime in like October-ish or November. This was the last property of a developer. He built it in 2016. It was purchased for $120 a unit. There was 3 years of a tax abatement left on it. So it was a great purchase right in the middle of Springfield, Missouri, which is about 2 to 3 hours south of Kansas City. The deal we're going to be talking about tonight is in Kansas City, but this property, 40 unit, was right smack in the middle of Springfield that pulled together 2 other properties that we have. So now we have close to 250 units over there. The 72 unit over there on the right is an A class built in 2023. It's the sister property of the first 72 units we bought right next to it that you see that we bought in 2021. And we bought both of those for a blended 117 a door, which is unheard of for A class. Just an absolute monster purchase. They are doing well. So those are our recent purchases. And Marco mentioned the 40 unit that is a JV that we bought in Kansas City, buying it in 4 weeks. That one is a distressed townhome deal. So if you're interested in getting to know us better and want to get into some more of a JV-like structure, we do have to get to know you really well, and for us to want to do that with you. But reach out to Marco.
Guys, for example, tonight's call, this deal is that we're going to go over is a 144 unit. It's a day one draw, the JV deal, and I'm happy about it. It's a 40 unit, 70% occupied, heavy lift. There's no draws for 2 years, but those are great deals because we're going to refi in year 2, and then we're going to draw after that. We're going to take out a nice chunk of money. So I'm happy doing those deals. But the day one draws are very nice for investors because people like to get money right away. But I'm a multifamily investor. I have 45 multifamily deals over 4,000 units. So I'll do a deal with no draws for 3 years because it's delayed gratification. I have the patience to wait to really make money. So it's just something about that 40 unit. And we're going to have future JVs like that where we go in, it's maybe 60% occupied, but there's a huge upside, but you got to wait for it. And that's true investors want a deal like that.
Go ahead, Nick. All right, so I know for some of the investors that are in with us for 10 plus deals, you guys are going to yawn. They have to hear us talk about ourselves again, but there's a lot of people on this call that don't know who we are. Krista and I are partners. We started Sharpline close to 8 years ago. We met at we have the same mentor, but we both were multifamily investors before, and we realized that our skill sets combined were better. 1 + 1 = 3. She's an absolute brilliant legal mind, also a great leader. And she's a wonderful partner. My background is in tech, actually. I was a tech guy for 15 years, a nerdy programmer that figured out how to get into commercial real estate over a decade. And, we found out that we love multifamily, but that's my background, is more of a tech ops and strategy perspective. That's my background. As you can see here, we've done a ton of units, have 9 full cycle deals. What that means is purchased, repositioned, meaning increased value, refinanced, and sold for profit. Done 9 of those. We probably have more than 15 years experience now with all the wonderful people on Sharpline. Probably, we have some serious people on here. There's almost like 50 plus years of very serious commercial real estate experience on our team now. Large amount of equity raised. A lot of people work with us for a long time. We are very grateful for them, for repeat investors. They keep on believing in us, and we keep on believing in multifamily. I'm going to let Krista introduce herself so that she can tell you about her background and how she has to deal with me as a partner.
We'll skip that part. Hi, everyone. Thanks for joining. Like Chris said, legal minds. My background is I started out practicing law, not practicing anymore. More of a disgruntled attorney that needed to do something different. And I got into real estate investing back in 2009. I formed a company with my husband, and we actually started out by flipping houses on Long Island. So we did that. And then in 2012 is when I got into the multifamily game, and I did properties on my own, multifamily acquisitions with some other JV partners. And then under a mentoring program, like Chris just mentioned, we met in 2015 and we formed Sharpline Equity in 2016. So we've been together a long time and have a lot of experience, have gone through a lot of trials and tribulations. It has truly made us who we are today. We're a much stronger partnership than we were when, back in the day in 2016. The growth that we've had, growing our team, becoming vertically integrated has been a huge improvement to our operations. Meeting up with MIH, we are about to embark on our 17th deal with MIH, or 18th if you include the 40 units. So that's a huge milestone to be connected to MIH for all these deals. It's been a tremendous ride that we are really enjoying. I'm very excited to be part of this team and excited for all these new people that looks like have entered into our world and are looking to find out about us. So I'm excited to meet you guys.
Go to the next. All right, Marco, go ahead.
All right, I'll try and make this quick. For those that don't know me, I am a former restaurant owner. I went to college for IT. For over 25 years, I did the restaurant business for my brother and father, won 12 awards. Sold it in January 2020 before COVID, achieving financial freedom at 44 years old. I am full-time multifamily, which I love to do. Own 45 multifamily deals. My goal is to get to 60 deals for my 3 beautiful daughters, over 3,800 units and 350 million holdings. And I'm a mentor at the MIH Mastermind. It's a mastermind group that I have, and a lot of my members are on tonight, of over 280 students, which we started in 2020. And some of them right there on the Cipriano. Thanks for coming, buddy. And I'm a father of 3 beautiful girls, which you saw one of them tonight. And multifamily, I will teach them, and is one of the assets that just like there's all asset classes are great out there, but multifamily has been able to make me achieve more time for my family. So that's it. Let's get going on to Eric, right?
Yeah, I'm going to embarrass Eric. He didn't actually know that he was going to be talking in front of 100 people. I didn't know he was going to be on. Eric, say hello to everybody.
Eric, it's only 116 people, bro.
Hi, everyone.
So Eric, an interesting story about Eric, and I'm not going to let everybody's eyes glaze over because it's like, oh gosh, here they go talking to Blue Street, but this one's funny and interesting and really cool, is the partnership that began with MIH started with the York 232 building in York, Pennsylvania, almost 4 years ago. And we purchased that building from Eric and his partners because Eric redeveloped it, gutted it, made it an A class. And when the inspectors showed up, they said, "We've never seen anything like this. There's nothing wrong." I don't believe what I'm seeing. Uh, Over the next 6 months, Eric and I got in contact with each other after the purchase of the building from him and his partners, and we've been working on projects since. And when you see us do $1.5 million in CapEx rehab or $2 million, Eric has started to work with us over the last 4 years, and he's headed over $7 to $8 million of renovations with us as head of construction. So when we are going to be doing $1.5 million of rehab on this, we got the right people. Eric is a wonderful person and friend and trusted person with vast amounts of knowledge, and he's an awesome Renaissance man. I'm not going to embarrass him, and well, yes, I am. I'm going to tell everybody. What did you graduate from Columbia from with medieval history as your major?
Yeah, one time that's what I did.
Yeah, Eric doesn't say much, but when he says it, he knows every single thing about the building trade. He is an awesome dude, and he's become a really good friend of mine, and a friend to all at Sharpline. We're happy to have him on the team. And then Josh, who's been an investor of Sharpline on quite a few deals over the years, left his printing executive job to get into the entrepreneur game, and we needed help hiring people because of the Sharpline community's self-management team that was hiring, and we needed to hire a lot of great people. Josh just said, "How can I be involved with Sharpline more and help?" Started there, helping bringing on fantastic people onto the Sharpline team, making a difference, and now just jumps in everywhere and is really heading up a lot of the unit turns, jumping in to help when we need to increase occupancy, just all around ops. Awesome dude. Great relationships with vendors, another trusted person on the team. Josh, get on here and give us your radio voice. Where is he? Because I can't even talk that deep.
I don't know if he's
Where-
on. He was
He
on
is.
it from before.
Oh, hey, sorry about that.
There he is.
Yes, I have a radio voice and a radio face, as my wife likes to say. You can appreciate the voice and, forego the face. I love real estate. I love working hard. I love people who love to work hard. It's a great match to be working with Sharpline. They're people who love real estate and love working hard. They're people who take their business very, very seriously. And I love what I do. So yeah, it's great. And I love this property, right? So happy to be here.
Thanks, dude.
Awesome. Thanks, Josh. Nick, go ahead. All right, let's get into it. What everybody's waiting for. All right. 144 units C plus class. And I'm going to say C plus. I know a lot of people say that, and then they're like, is it really? Yes, it is. And I'll tell you why. Because on CoStar, it actually calls this a B. I'm not going to call it a B. I'm not that guy, but it is a C plus. I'm saying it. It's 1972 built. There has been a fair amount of work done to it in the last 2 or 3 years. About 70% of the roofs have been replaced. We have money for the remaining 30% to replace and repair. The mansard roofs, that's the mansard roof that you've seen in this 1970s product is that side roof that comes down. I get it. It's not the prettiest thing ever in the world, but this thing makes money. So we're going to fix some of that mansard roof shingles. And also, I don't know, some of you may know, not everybody's going to know what this is, but we did do 2 deals where we ripped the mansards off and made it like a cube. They look great. Eric was involved with that really great end product. I should have put that on here, but the reason I didn't is because we're not getting rid of the mansards. It's just no reason to get rid of the mansards here. So we're keeping the mansard roofs. There was a time on Facebook where I was known as the mansard slayer. That's not happening here. We're going to self-manage this with our Sharpline communities. And I know what you're looking at. You're waiting for me to say it. Price so good we can't disclose. Yes. We literally cannot tell you what price we're buying this at publicly because we signed something contractually that says we can't publicly say what we're buying it for. Don't get scared, everybody. Those investors, but like when you see the executive summary, it will be in there before you send your money. You will be able to see what we bought it for, so don't get nervous. But we're not publicly going to talk about it because It is a publicly traded company that is selling this to us, and they don't want us to publicly talk about what we're buying it for in a public nature. So nobody's allowed to do it.
Let me elaborate a little more. Usually when we close a deal, we'll go on Facebook, on social media, and we have a company. We're helping build the brand Sharpline and coming together, and we post the closing, and we have a very big exposure, and we close the closing on purpose because sellers, brokers see us, and that leads to more deal flow and more opportunities. And we want to post this closing, but because we're getting a very good price on it, they have a lot of deals. And they know we have me and Lauren. We have a very big social media following on Facebook, Instagram, LinkedIn. We share everywhere. And that's, we're really good at social media. We have to agree not to do that because they don't want their name to get tarnished. So
I will make references to the price in a roundabout way without disclosing, because it is pretty it's pretty freaking good. Let's go. Next slide. All right. We got to move this up a little bit. My screen is weird.
For the new people, he'll explain 7% cash on cash.
I
There'll
will.
be a bunch of new, Chris.
Sure. So this is what's called a 506B offering, meaning that an investor has to have a pre-existing relationship with us or one of the GPs in the deal. So if you're not, please develop a relationship with us. A 506C offering is when you can go public and just blast everywhere, but that means you have to be an accredited investor, which has certain income and net worth requirements. This is a 506B offering because we've had such high interest that everybody that we have relationships with. This will be another one of our monthly distribution deals. We believe will produce a 7% plus average cash on cash return, meaning when the property is given distributions out, it will be annualized 7 plus, a 16% IRR. That's a time value of money thing, but for ease, it's essentially if we hold it for 5 years, it would be the return, including the profits at the sale plus the cash flow, would equal 16 times 5. So that's essentially what it means. There is a 1.7 equity multiple. That's essentially where you get the 7, you get your original capital back, plus 16 times 5-ish. We do plan on this one being a 3 to 5 year hold. Sometimes our holds are 5 to 7, 10 for long-term holds. This one is positioned that we believe most beneficial for Sharpline and our investors because it's a 1970s built and we are putting the right capital in, but we do feel that this one's going to benefit the most from a 3 to 5 year hold. The debt we're putting on it will allow us to hold longer if we need to, so that if we need to mitigate any risk at that time in the market, it allows us to not be forced to do anything. And we will start the monthly distributions at month 3 or 5. We like to purchase a property, see how it feels, see how see if we got everything right, like understand the surprises, and then start distributing. So the monthly distributions will start at 3 to 5 months. And there is a refi potential on this because of the rent increases that we feel we're going to achieve with this, like straight down the fairway, stabilized deal that does cash flow day one, which is great. But there is a refi potential for giving the capital back in approximately year 3. Let's go to the next.
One thing I'd like to say before we move on is for the new people on here and for the people going, oh, I was just on a call with the tear sheet of 23% IRR. I love those. At Sharpline, I've closed 17 deals with Chris, and we've raised over $80 million in one day, usually after the Zoom, and 6 of them were pre-funded before the Zooms. We under promise and over deliver. We're not looking to put a tear sheet of 23% IRR, especially in a recession, to attract more people. What we say is you could put a 23% IRR tear sheet, and then if the team doesn't run the deal well, you can have a 0% IRR. So it's not what it says on the sheet. It's you don't just invest. This is the quote. You don't just invest in the deal. You invest in the people with the deal. So anybody can put a fancy and cute tear sheet up, but you're looking at the team right here. Our advantage, we self-manage. We do not use a third-party property management. This is the biggest part of the call right now. I'm going to say it slow. I would not take your money, anybody here, if we did not self-manage. 80% of the syndication companies out there use 90% use third-party property management companies. We self-manage. My family, my friends, my daughter's money, my money, I would not raise money if I did not self-manage. And like I said, most of them use third-party properties. I have a responsibility that if things are going right, I can work 7 days a week to try and make them go right. When you use a third party, it's in their hands. So that's something I'm very proud about, Chris. So that's why I just want to let especially the new people know the difference of using third-party property management, a company, or if we're doing it in-house on our 17 deals.
Yeah, I mean, it's an important point. The buck stops with us. We're responsible for everything. So, you know, we're transparent when we hit some bumps in the road if we do, and then our team gets to work and gets their ass on a plane to fix the problem fast. Is the third party management going to go do that? No, they're not. They're just going to go tell you that they fixed it, and then you go see it the next month, and you're even like feeling worse. Our team are a bunch of maniacs. We'll show up in 24 hours, and the whole team will descend like freaking Halo coming down from planes. Night vision goggles. That's our team. That's Sharpline Communities. Don't forget it. That's badass. That's our team. Protect the realm. You'll start to see that. You see the gorilla? That's what we say. Protect the realm. So obviously you can tell I'm pretty passionate about that. Like this property, I mentioned a couple things here. I'm not going to go over every single thing, but basically what we like about this property is it's got a really nice unit mix. It's got 1s, 2s, and 3s. In the 2s, also half of them have 1.5 baths. So, and it's got a high concentration of 2s, which is nice. So really, when you say average rent, you're feeling like it's most of the 2s. The 1s and the 3s aren't skewing it in one direction or the other. And you should look at that on some properties when you see heavy weighted 1s. I don't know if you're going to get your average rents the way you want. On this particular property, because it's got a nice unit mix, we feel really confident about the average rent. Current average rent is $850. That is like really down the middle low for this area. Get nicer product, nice delivery of a great experience by Sharpline Communities to our residents, and that's going to go up by 150 to 200. And by the way, I'm jumping ahead because that is on the next slide, but Nick, don't move to it yet. That's a projection 3 years from now. So we have time to get there, and the returns are based on that kind of thesis. The purchase price, whoo, man, this one came in, and I knew I had to hustle. This is about relationships, getting the call, and knowing that you can get the right debt. Get agency. This is an agency fixed debt loan. There's going to be some IO on it, interest only, and just yesterday, Josh and I got a broker to call us with a 1950s and 60s product, similar unit count and everything, and around the same area. And it was like, it's 25% more than this was per unit. Unbelievable. Haven't seen anything like that. We have 700 units in the metro. This will bring it to about 1,000, which is pretty wonderful.
Hey, Chris.
Go ahead.
If I can add one thing on pricing, one thing I thought was very interesting about the deal negotiation is a price was settled on and appraisal came in a lot higher. And what happened?
So the appraisal came in a lot higher. And the reason that it came in a lot higher was because they were using the numbers that we're going to use we have 700 units in the portfolio. We can prove that these are our expenses. The reason we were able to get this was because the expenses are so high loaded on this that certain aspects of this fund had to have higher insurance qualifications for it, low deductibles. And when that happens, you have a fixed cost on your P&L, your profit and loss statement, and now you're stuck. That's the value. We had to prove to the banks that we had enough properties and enough wherewithal, enough experience, enough proof that we can run these properties less. Had an insurance quote, proved it. That's how we were able to get this, so that we will be able to showcase that the appraisal was it came down, even though we know our numbers. When we do it, the appraisal was higher. We're buying this with instant equity, but the appraisal had to come down for them to sell it. And the way that was done that was because they had very high expenses on their insurance, and we were able to bring that down. I mean, 97% occupied we're walking into. I mean, all right. The collections are strong. Told you about the roof, so I don't have to go into that again. But we do the work. Sharpline does the CapEx. you know, Sharpline gets beat up a little bit sometimes, like Marco mentioned, because we don't pop the 23% IRRs and things. Like on our JV, we have a pretty high return profile, but it is a smaller group, and there is a heavy lift component that's pretty significant. But we do the CapEx on these deals. We do it right so that you don't get caught. On a lot of the deals that are getting in trouble out there, they don't manage their capital right. They get like issues happen on a property, and then they didn't account or keep enough cash around, and then a surprise happens, and it creates a lot of issues for the operators and the investors. Sharpline does their very best to really load up on reserves and CapEx so that we don't get ourselves into that situation. That is definitely a Sharpline advantage. Go to the next one, Nick, please. All right, the upside. Here we go. The renovated units are this style on the top right, and 30% of them are of that quality. I mentioned we're going to lower the expenses. We were actually able to get a 70 to 75% loan to value because of our expenses. Any other buyer that shows up at this property probably would have had to put 50% down because they didn't have the breadth of T12s of different properties that you can prove to a lender that you know how to have these expenses at this low. That's an advantage to us. That's our upside. Going to bring the rents up, like I mentioned. The submarket average in this area already is 1,000, and we're at 850. So it's just like helium going to go up. Operational efficiency is pretty serious. 1,000 units in Kansas City, when you want to do some work and you want to have some power, you can get some things done and get them for a better price than the next person. I mentioned this, the 25% higher. Josh talked about that. You know, the average sale price in this area is 100 per unit right now. Crazy. That's the value that we're looking to get to for refi and sale later in 3 to 5 years. All right, people, let that one sink in. Rewind that one a couple times. Fixed rate debt with agency. Awesome. I have a great relationship with Freddie and Fannie. We're going to do 30% of the roofs. We don't have to do much to the outside. It's really clean property. I mean, I know this. When Eric Peel, our head of construction guy that is the Renaissance man, goes into a C-class 1970s property and says, this property is clean, we are ready to go.
So guys,
this thing was...
one thing Kristen mentioned about Eric, when I go on inspection with Chris and Eric, not all teams have this. In my mastermind, I teach my students, they don't have this. We have a roofer come and he goes on the roof and he goes to check the roof and he's going to give us a bid. What happens if me and Chris are just there and we have no building experience? He comes down and he can go, hey, Chris, $100,000, you need a whole new roof. But we have Eric. He's a builder. Eric goes on the roof with him. Eric knows to the penny what it costs because Eric builds. So the roofer goes, oh, crap, I got to give him an honest bid. And we obviously we get 2 or 3 bids. They come down, and on our last project, a while ago, 115, we put 500,000 aside for the roofs. Eric went on the roof, all 8 with him. The flat roofs came down, and the roofers looked at Eric and goes, yeah, you only got to replace like 3 and repair like 8. It's only 200,000. We just made 300,000 and we put aside to spend on the rest of the property. And having Eric there is, we know we're not going to get ripped off. And not everybody has that luxury. Not everybody has a builder on their team.
Let me tell you this too. It's happened twice. I think it's happened 3 times. We've been in contract and Eric Peel has said, do not buy this building. So there is that discipline that we've had a deal where Eric walked it and he was like,
Indiana.
Like, it was Oklahoma. It was like, do not buy this. Like, this is not one you want to own. So we've been there. It's not like everything's just thumbs up and rainbows and stuff. We know when we're walking away. The option for the refinance in the future to hold or take advantage of an opportunistic sale. This one's positioned as this type of investment, as I mentioned. We have a lot of choices. That's great in an investment. It mitigates a fair amount of risk. It's a choice, allows us to not try to time the market, but actually us time with the market and take advantage of it. So we have quite a few levers on this one. So that's another advantage of this deal. You can see the classic nature of these. We're going to put in an average of 8,000 per unit. Some only will need 3 or 4. Some will need 12. but we're going to do about 100 of them. And that will still leave meat on the bone because we won't take every single one of the classics to like premiere. Because if you take every single one of the classics to premiere, the next buyer will say, what do I do next? So you've limited your pool of visionaries, if you will. So this allows us a multiple level of premiums, if you will, that still leaves meat on the bone for the next buyer to want to take it to the next level when the market conditions allow for that. Go ahead, Nick. All right, Kansas City is wonderful. Went into Kansas City about 2.5, 3 years ago. I missed it by 1 year. Should have bought another 1,000 units before the year before, but that's what happens. And like, we love Kansas City. It's been really great to us. You know, you're going to hit some ripples sometimes on a deal here and there, but you solve it and you get back to it. But Kansas City is a market like that that allows you to do it. It's not one of these huge sine waves of like appreciation. If you get it wrong, there's no way it comes back. It is a steady eddy moving up market, and that's a market that we like and can work with, especially with a self-management team that allows us to pull all the different levers that we can. Population growth is good, a solid. I mean, population growth. Oh, look, I didn't send it to Krista first. I have a misspelling. Kansas City. You would have gotten that, Krista. She, hit like 1% is considered awesome per year. 81% right now, great. I mean, you got 2 million people in the MSA. Diverse employment, we like to see that, a wide variety of employment base. You just don't want a one-trick pony in a market. In a market this big, usually you will have a diverse market of employers, which we do. That airport is kick butt. I got to tell you, like flying into the old Kansas City airport, you did fly in and say, is Kansas City really good? Question mark. It just 1970s building. It wasn't inspiring. The new $1 billion plus airport's pretty amazing. Like I do think that over time, you're going to have huge company investors and large equity come in there, starting to get more of the institutional money. It's already there, but it's just getting noticed and noticed and noticed. And it's important. You show up in an airport, you can't ask, am I in the right place? I mentioned the stable economy, really important for us for values and rents just constantly going up. And you know, KC is ranked in the top 15 of GDP growth, like some of the big hitters, and it's even ahead of Atlanta a little bit right now, which is pretty interesting to me. Just a fantastic market. We will continue to buy in Kansas City for the foreseeable future. It's been great to us. Next slide. And this is kind of a signature Sharpline pitch. So we don't go super data oriented. All that stuff is in the executive summary, and that will be there early next week. The portal is open. You do have to be a portal user on the Invest With Us link. You can go there and submit, and Rainbow will let you in. To get in this deal, we do have to know you, or one of the GPs has to know you. But the portal is open for soft commits. We've been getting some already. And we just like to keep it, 45 minutes isn't short because we had to introduce everybody, but we want to. You're investing in people too, mostly the most important thing. So I wanted everybody to meet some of our superstars that haven't been met before.
We already got some questions I'm going to cover right now before we even start taking them. Number one, I just put my Calendly link. Guys, if you haven't met me, book a call. 15 minutes, half hour, just to get to know you, build a relationship. I put my number up there. You could text me also. I also put the portal link up there in the chat. If you scroll up, it's at sharplineequity.com, and then just go click invest with us. It says it right there. My cell number is right there. Minimum couple questions. I'm going to tell you how it works with Sharpline now. If you are interested, what to expect. We walk you through the whole way, especially if you're new. Like Dr. Kokar, he's in 12 deals with us. Dr. Kokar knows exactly what's going on. I don't have to help him or anything. Even Sunil and all our investors that are on here that are in multiple deals. But if you're new, we do walk you through it. Like I got Andy on here. Andy Hubbs, my very close friend. He's in the mastermind, my partner. He's got some people interested. So if they're new, I do help Andy. I take the time with Andy to get on and help everybody. One thing that we're going to do now, after this call, people go in that are interested. You could soft commit. You don't have to soft commit. You can reach out to me. We don't really care about soft commits. It is good to do that, but and then after today, Chris, what do we normally say? Because we don't have any holidays right now. 7 days after today, we're going to send out an email to the people who have emails on there. with the whoever soft commits is interested, with the executive summary. It's a 32-page document with the comps. It's really nice to learn from. A little snapshot of the underwriting, everything that's going on. 32 pages. You could learn from it, and then it'll have the docs to sign. So you look at it, write down your questions. I could get on with you. Then if you're happy, you could get on, and it's 5 clicks to sign docs. When you're new, I walk you through it. When you're not, you just do it. Then once you sign, after 7 days today, the wiring instructions come up. And once you get the wire instructions, you could start wiring the money the following day. And we give up to like 5 days. We give like a time, because people at work can't get there right away. So that's something simple. But I'm trying to think, what am I missing? No, the email comes out and that's it. And anything that somebody's new, they don't understand, we will help. And before that, for the new people who have questions, reach out to me, write your questions down. I'll answer them all. I saw minimum investment. I put up, question was 75K. Most of my doctors put 100, because like Sunil Gupta says, 75K for a doctor really doesn't move the needle. Most doctors that invest in our group, they usually invest 100 to 500K. My company usually invests $400,000 to $500,000. And then on top of that, Chris and Sharpline, they also invest. We usually invest close to 600 to $1 million, more on the top end. If we do 7 deals a year, it's hard to stay liquid, but we're usually putting around 600 of our own money. There's not a deal. I would not do a deal if we don't invest in a deal. And I would advise you guys, if there's a syndicator out there doing deals and they don't invest, I really probably wouldn't invest in it either. Let me move up. What closing date? Chris, when's this tentative closing date after we wire? Do you have an idea?
Yeah, like it will close at the end of April, so it's not going to be with the money hanging around too long. Probably, wires will be taken in sometime in the beginning of April, so we can collect in time, or the very end of March. But yeah, I've heard that recently with some other groups that wires have been put out there and it just sits there for months waiting for it to close. No, that's not Sharpline. So yeah, it's scheduled to close for end of April.
Sarah Erickson, I saw, said, how do I get in touch with me or whatever? Definitely send me a text and I'll set up a Zoom call day or night. If you busy during the day, I do calls at 8, 9, 10 o'clock at night, especially for busy professionals.
Let me answer. Let me just before what you'll see inside the portal as we start filling the portal with more information. Currently in there is the tear sheet, which is just a little mini version of the deal outline. And then there's the PowerPoint tonight. Probably within the next day, this webinar will get converted to a YouTube link and it'll be put in there so you can rewatch it. And then within a week, we will have the executive summary done. And then the executive summary does list out everything. Some of the key points that for a lot of people they would want to see is you will see the rent comps, you'll see the sale comps, you'll see the pro forma, you'll see what the sources and uses are for the various capital and reserves and CapEx, and inside of the CapEx rehab, where that money is going to go. Everything is listed there. It'll showcase the team again, its location, everything is there. And then when the documents are ready to be signed, all the subscription agreements, PPM is there digitally for ease, but also ease of viewing. So everything's there in a professional manner that is all reviewable, signable as quickly as possible in an easy manner, and then also contained there afterwards for your organization for later.
Pat, the total raise a question, $5 million even, Chris?
No, it's right now, we're getting the final loan proceeds. It could be anywhere from 71 to 75% LTV. So I'm going to call it somewhere between 5 and 5.3 right now is the raise. Right now, the numbers are based on a higher number so that it doesn't skew it if we go down a little bit. So it's at 5.3-ish right now. All these numbers are based on 5.3. So that's just so you don't worry about that if we raise more and then it goes down. What other questions?
I got one from Molly. Molly, this is like not a tough question, but it's like a long one, but I can answer. What mistakes have you made that gets you to where you are today? So Molly, I'm 49 years old. My father, who was an immigrant from Italy, didn't go to college. He taught me at 23 years old how to buy a 4-family. We did it the old school way. At 23, I didn't know anything. And he showed me how to buy it himself. And he told me, Marco, you need to work at the restaurant, make a lot of money, and you need to buy multifamily. Whether it's 2 units, 4 units, single family, whatever it is, he goes, you need to do it. It was a really tough property with no parking lot. It had dirt road. It was a disaster. I looked at him, I almost threw up when I was looking at him, like, we're really buying this? He says, yes, you are. And we're gonna fix it. I'm gonna show you how. And he had no education. And I learned at 23 how to fix a 4-family, and I ran that for 20 years. And I started like that, and then that was 1998. 2013, my brother and me, we figured out how to invest out of New York and make more money because you don't cash flow in New York. I lived in New York, and then I moved to Florida just 3 years ago because I sold my business. On the way, I did learn one time in 2007 with an investor, not a syndication, an investor. I learned the hard way, and I invested in a good property. It was a bad partnership. I lost 150,000 in my own money in my own partnership, and I learned that we need a great team, and that's what we have here. That I was referred to this guy from my accountant, and he's a good person, this and that. And me and my brother always invested just together. Me, my brother, my father. It was 2007 in that recession, and I trusted somebody I really didn't know well. But after that, what did I learn? In 2012 to 2020, I closed 2,000 units on my own with me, my brother, and Jake, another partner. Just us three. And then I met Chris in like 2016, 17. I became very close to Chris. And like I said, the only reason I do syndication, because I own 28 properties on my own with just 3 partners. The only reason I do syndications is I found Chris and I found Krista, the right team. And the only reason I raise money, and my older brother, who's 4 years older than me, doesn't want me like at first to do syndicate because he worries about his younger brother. I told him that we're self-managing, as me and him self-manage our other properties. And that's the other reason, is because we self-manage. So what I learned on the way, I have 25 years experience. I learned a lot. You know, I did make, of course I made mistakes on the way, but I made mistakes on my properties. You know,
Marco, I'll add that the mistakes that we've made from an operational perspective are, just as you mentioned, we didn't know how to do it at first. We had to learn the ropes to be able to self-manage properly. So we had to go through that journey. But yeah, third-party management, bad. Now we know enough over the years to be able to self-manage correctly. And then another item is overdoing unit turns.
If you start your descent,
Overdoing unit turns, spending too much on the unit turns. Sometimes you wish you could have pulled that money back and spread it over more unit turns, and just have maybe gotten maybe not as high as a pop, but it would have spread more turns. Turns cost a lot more than people think on properties, so it's about managing your turn buckets really well, and a lot of groups do that wrong. We've learned the nuance of how to do it, and we get better every year. We learn from every property where to find the sweet spot on each property. What else?
Let me see. I think that was pretty much, I'm going back up, just looking real quick. I don't want to miss people, but I mean, the answer to the questions tonight, it's important, but it's not that important because I want to talk to people if they really want to answer stuff. So yes, yourself, man, hold on. I think that's it so
Will
far.
you have an on-site dedicated staff leasing office? Yes, we will at this property.
That is correct, Nick.
So-
Yeah, it's got a pretty decent leasing office on this one. It's right by the pool. That pool, we're normally not pool thumbs up type of owners. We'll give it a chance. It is pretty nice looking pool, and we'll see this summer how it's used, if it's worth keeping, or making it more of like just filling it and making it more of a barbecue pit. You know, it's interesting. You talk to insurance carriers, and you know, I talked to ours, State Farm, and they have like group policy over many, because we have geographic diversity, which is quite beneficial to an insurance carrier to have different geos, because then they like us as operators. They don't have risk in one area, so they like us a lot. The pool didn't really make a difference to them. So yeah, but the leasing office, this one's really inviting, and like it's prominent.
Guys, and I'm not afraid of this. it's multifamily was a scary space last year. November 2022, on my chat in my education group for 280 of my students, we could get like vulnerable and everything right now, like transparent. I went on the chat and I said, guys, I just told my wife I'm retired, and I told my wife 2023 and 2024 are going to suck. I said, I'm going to work my ass off. And she goes, but you're retired. I said, I'm an entrepreneur. I own 45 deals, sweetie. Entrepreneurs don't retire. I said, I sold a restaurant, but I'm working even more. And what we did, we deemed it the year of operations, and we were right. So somebody just put up there, have you ever had a capital call? Last year, there was a lot of foreclosures of people we know of, and I have 45 deals, and starting at 23 years old. And I could say right now that I'm grateful that we have not had a capital call. And you should ask that question. If you guys are going to invest for the new people, you should ask, hey, how are your deals going? How's your track record? Did you, and if they had a capital call, it's not the end of the world, but did they make the capital call and fix the deal? Or did they do it the right way on the capital call? Why did they have a capital call? Was it negligence or was it just an honest mistake? So grateful to say, up to this date, we have not had a capital call. Yeah, and I
Oh,
attribute.
Marco, I just saw a question. It was about communication to investors. They're inside the portal. We do send a monthly update, and then every 3 months there's financial update, and then we do webinar. Nick, what is the now frequency of the webinar?
Twice a year per property. We do it on Wednesday mornings.
And if there's anything on the property that is really good news or challenging news, we do communicate well. You can ask around. Sharpline communication is definitely tops. I mean, we always strive to even do better, but we do feel that we communicate well. I
Guys,
think, Mark,
I'm being serious. Guys, text me to have a quick 30-minute cell call. It doesn't have to be Zoom. I love meeting people. I love people. I love my mastermind. As you guys can tell, I love to network. The one main thing I attribute myself to my father. My father came here with nothing, and he was a go-giver. And that's what he taught me and my brother to be. And ever since I sold the restaurant, my thing is to help people, educate people, and give them my time. So I definitely look forward to speaking to a lot of new people that were on here tonight. I hope that you guys reach out to me. For people that have never made a deal, never had a ton of money, what would be a good investment for Sharpline? Steven, you should text me and I can give you some good advice for free. So for people who have never made a deal, never had a ton of, nor have a ton of money, it depends on your finances. I mean, a good multifamily deal, whether you put 50,000 or 200,000 is a good deal. It just depends if it fits into your finances. You know, you don't want to leave yourself too short, but I can get on and guide you on something like that.
All right. Thank you, everybody, for coming. There will be more information in the portal that you can consume and read, and then ask us questions.
Thank you very much, everybody. Krista, Josh, Nick, Eric, everybody, all my MIH members out there, all the new investors, really appreciate you guys. And like I said, we'll talk to you soon.
Thank you, everybody. Appreciate you.
Have a great night.